today, and I'll let Greg just take over financing your business. Greg's from the Small Business Administration. He does a lot of these workshops for us, so we appreciate him. And go ahead, Greg, your show.
All right, Stephen, thank you very much. And thanks everybody for joining us this morning. Yeah, no, it's good to be kind of getting back to normal here. I guess as someone from the SBA, it's my job to be the bearer of bad news or good news, whatever it may be. But, as we have kind of come out of the pandemic here, we don't really see any more, funding coming from the government in terms of, PPP type programs or anything like that. There is finally a bill that passed the House to top off the restaurant revitalization fund for those that applied that didn't get money. So we are hoping that gets through the Senate. And then anybody that had applied previously and would be approved would be able to get some funds. So that would be nice as far as a kind of leveling of the playing field by Congress there. But stay tuned, because that still has to make it through the Senate to make it work. So this morning we're talking about financing your business, and we're kind of getting back to basics here. It's time to figure out where our business is, where we sit, what are we looking for, what do we need to do. A lot of businesses are still working through economic injury disaster loans or have received them from the SBA. So there is some cash there that they've been working on. We still have some funds. They're going quickly. So we're almost towards the end of that program as well. So a couple reasons, most businesses need funding. The first one is cash flow challenges. When you start a business or when you own a business, you gotta purchase inventory many times to sell your product. You got to pay your employees, you got to train them, right? You got to market your business and get the word out there before you can even generate cash and sales for the business. The second major reason is capital investments. So many businesses need to buy a building. Many businesses need to do leasehold improvements if you're renting a space, purchase equipment, machines, whatever it may be. And those can be costly and something you want to look at, amortizing over the course of, 5 to 10 years sometimes versus, having to pay everything up front. And then the third major reason is lengthy product development cycles. So some products take years and years under development before they can even generate any money. And, businesses may need an investment in equity and or some sort of financing to, again, pay employees, to move through the process, to be able to, keep the business afloat until they get their approval. A lot of times these can be your high tech, types of things, or you think about, drug development and that sort of stuff, cancer type drugs, whatever they may be. That's when these longer product development cycles come into play. So some things we like to, say that you should ask yourself before you even think about financing. A couple key questions here is, how much money do I need? I know, Jessica on the line here will tell you that, a bank wants to know exactly how much money you're looking for when you go in to get some financing, right? They don't want to hear, well, maybe 50,000, maybe 150,000, right? That's a pretty significant difference in what you'd use the money for, and what you may what you use the money for and how much your payment might be. Excuse me, haven't had my coffee yet. What type of business is it? Every business has a different kind of risk to it, right? Inherent risk. Banks know what that is. They have this little book called RMA, a pretty big book, that tells them exactly what type of profit margins, are seen in each industry and that sort of thing. So they can have a pretty good gauge, right? We all know restaurants tend to be a little bit more riskier, right? Businesses like that. So some businesses have that stigma attached to them, right? When you're going in for a loan. What type of capital is most appropriate? So do you need just a fixed term loan? Do you need a fixed term loan in conjunction with maybe a line of credit, right? Do you need some sort of equity investment from an investor who, may not take something now, but is taking a percentage of your company over time? All right. And that, kind of leads into how much control do I need? If you borrow money from a bank, you have 100% control of your business still. If you get an investment from someone in the form of equity, you lose partial control of your business, depending on how much the investment is. Okay. And what is your bargaining position? When we look at your bargaining position, the number one thing that banks are going to look at is credit score, right? How is that credit score? Before you go to apply for a loan, is there something you can do to increase that credit score, right? Banks want to see, people many times, 720 and above, right? You're getting the best rates. 650 and above, you could probably still get some financing. Once you get below 650, it gets to be a little bit more dicier. So you really need to manage your credit score and understand where you sit in order to, be able to get the best deal for your business. Some sources of financing when you're looking to get funding, your personal funds, money you have saved, traditional debt, which would be a bank loan, an SBA guaranteed loan, which is a form of a bank loan that's guaranteed by the SBA. Crowdsourcing, right? We've all seen these kind of GoFundMe and that sort of stuff. That's a thing that you can do online. You got to have a good marketing campaign. Much harder to crowdsource funds for a business unless you have a pretty unique product most of the time. So the companies that tend to be successful crowdsourcing tend to have a unique product and have done a very good job marketing. Peer-to-peer networks, right? There may be people who can lend you money, right? People your friends know that might be able to lend you money that you may be able to have a discussion with. Microloans are loans that tend to be $50,000 or less. And they can come from smaller intermediaries who are able to provide funding. Angel investors and venture capital are both equity investments in the business generally. Angel investors tend to be, that's one person, who has money that is investing in your business. Venture capital is a managed firm of angel investors usually. So, maybe there are 10 angel investors who give a venture capital firm $1 million each or whatever, and they use the venture capital firm then manages that money in order to invest it in different businesses. Most of the time, those angel investors and venture capital folks are looking for, kind of high growth, scalable, high tech businesses. They're looking for the next Apple. They're looking for the next Google, right? Those sorts of things. All right. So some other important considerations to think about. How much have I saved to contribute towards financing my business? All right. Most banks want to see that you have 20% down if you're looking to do a project. So if you write your business plan and do your financial projections and say, hey, I need $100,000 to start my business, the bank's going to say, great. Do you have $20,000 of your own money? And we can lend you $80,000 to make that $100,000 a reality. Are your personal finances in good shape? Right? When you apply for a loan, it's about your personal finances. Most Some businesses have enough credit but they have to be long-standing, and there are a few hurdles there. So most of the time you're looking at your personal finances, because most times you'll be personally guaranteeing these loans as well. And then we talked about it before, but what is your credit score? That's really important to trying to get financing for your business. So when we talk about personal funds, you need skin in the game before you seek any external financing. And this is that 20% that I just talked about. You got to have something of your own to bring to the table. Otherwise, a bank is not going to lend to you. Excuse me. So some sources of personal funding, your cash or savings, bootstrapping techniques, getting what you need without spending as much on it, home equity lines of credit, your friends and family, credit cards, equities and stock portfolios, retirement accounts. So these are the places we see people getting that money for their personal funds. Obviously, we don't recommend using credit cards, but sometimes it happens, it has to be done. We see a lot of people pulling money out of retirement accounts and that sort of thing. And there's, equities and stock portfolios in order to meet this, that 20% goal when they're looking to start a business. That tends to be a way folks can get that done. Bootstrapping is finding ways to avoid the need for external financing or funding through creativity, ingenuity, thriftiness, cost cutting, or any means necessary. It's the most common source of startup funding, and most entrepreneurs bootstrap out of necessity. So bootstrapping, will kind of go through it quick here, but again, it's getting what you need without having to spend full price on it, right? So buying used instead of new equipment, right? You're starting a restaurant, you need pizza ovens or fryers or whatever else. You buy used ones instead of brand new ones and save yourself a bunch of money off the top, right? Leasing equipment instead of buying it, right? We know that if we lease a car, the monthly payment is less than if we buy the car. Same concept when we're looking at equipment for our businesses, right? You lease the printer instead of buy the printer if you need, right? That sort of thing. Crowdfunding, again, that's a way we talked about potentially to raise money, but tends to be pretty difficult. Sharing office space with other businesses. If you're in a business where, we see, attorneys and insurance people and, salespeople sharing office space, because, they don't need maybe the whole space in a retail setting, so they can have, 3 of them in a place and share the rent together and not have to pay all that rent. So, things to think about. Coordinating purchases with other businesses. If you know someone, in a similar industry or who needs to buy something similar to you, maybe there's a way you can, work with that vendor to save some money on shipping and get things, at a cheaper price by buying larger volume. This is looking at different ways to save money that are out there that you might not think about off the top of your head all the time. Obtaining payments in advance from customers. So, or even getting a down payment from them, 25 or 50% before services are provided, right? So that you have some cash flow to purchase inventory, to pay employees, to provide whatever service or product is going to be delivered to the customer. Vendor financing, right? You can get financing from your vendors, and this can be on monthly things you buy, or it can be on equipment from vendors. Ask, many of them provide it, and it could help you out and save you some cash up front. Yes, in the end you might pay a little more, but that monthly cash flow is so important, especially when you're starting the business, to be able to kind of save where you can. And making do with what you have. If you have an older Dell laptop now, and it still works fine, right? You don't need to go out and buy the new Mac, that's $3,000 or whatever. Maybe there's, a better investment of that money for your business. And that's what we're trying to get you to think about when we talk about bootstrapping. Where can you save money, right, to invest that money in other more important places of the business. All right. Any questions on any of that stuff before we head on? Everybody can hear me, right?
Yeah, we're good.
Okay, just wanted to make sure. My little green box isn't lighting up over my name, so just wanted to make sure there. So, all right, thank you. So borrowing money, what you should know up front. There's no such thing as 100% financing, okay? We talked about that, that's the, I call it the 80-20 rule, right? Bank will lend you 80%. You can, want to make sure you have your 20% down. Depending on your credit situation, size of loan, and many other things, you may be able to get that number to 10%. But, as a rule of thumb, we like to say 20. And that's usually what the bank would tell you too. There are no grants for general business purposes. We've seen, a lot of grants that were COVID related over the past couple of years, but those are all gone. The only thing you may see grants for now, some counties have leftover money from some of the COVID money, and I've seen them putting out some different grants for facades for buildings on Main Street and different things. So keep an eye on those, but those all happen more at the county and state levels versus anything that would happen federally at this point. Your personal credit history is very, 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 very important, right? That makes the difference in getting a loan or not getting a loan, getting favorable terms or non-favorable terms. Just something that you need to really pay attention to. A lender will most likely require a personal guarantee from you. So a personal guarantee means that you are saying that if the business, goes belly up and doesn't make it, and you're not able to, continue on with the business, you are still personally liable, right, for the funds. Okay. And that guarantee will many times come in the form of, equity in real estate or equity in a retirement portfolio, a cash secured account, many different things, but the bank needs to have another way out, right, to be paid if you are not able to pay back the loan with them. And the SBA no longer makes direct business loans, right? We do direct loans for COVID or for economic injury disaster loans, but all SBA loans are made through banks. So through your M&T, KeyBank, Five Star, Tompkins, whoever it may be, right? And those loans are done through there. They're, pretty much every bank in the area is a preferred lending partner. They're able to approve them on their own, and the money would come directly from there. So when you're looking to borrow funds, your first stop is your bank. So if you need to borrow money, you got to go to a bank or other lending company. We always recommend you go to a bank that you already have a relationship with, your checking account, savings account, mortgage, car loans, whatever it may be. And if you don't have a relationship with a bank, pick one that's close to the business. And you have to understand and think about what are the needs for your business. We recommend interviewing 3 banks. As you're going through, some banks charge for checks, some don't, right? Maybe you're selling products and services internationally, while some banks, have a more robust international, finance department than others, right? So you have to really think about what are the services that your bank needs. Maybe your business collects a lot of cash. You need someplace to deposit that cash quickly, right? And maybe you need to be able to do that in off hours, right? What are the services that your business needs, right? Think about that. And then as you go to the banks and interview them, you talk to them and ask them about those, services that are most important to you. And then that's how you can make your decision, okay? First stop is a bank. After you go to the bank, you're gonna ask to speak with the manager, assistant manager, or loan specialist, okay? You're going to be selling them your idea about your business, your products and services, right? In this meeting as well, okay? So you need to be able to articulate your business plan and share it with them, okay? At the meeting with the bank, we recommend you have your business plan and financial projections, a personal financial statement and 3 years of tax returns, and a resume too to show you have experience. So, all right, if the bank thinks that they can go to the next step with you, they'll discuss about applying for a loan, okay? After you complete the loan application, the lender gets the loan application back and it goes to that underwriting place, right? That's the scary place in the bank that nobody knows what's going on. People with green shades down there, right? Going through all of our financials and everything else. And that's where the bank will take a look at, to see whether they can make a loan and what the terms and conditions might be, okay? Something to note, and you've probably gone through this, getting a mortgage or anything else, but lenders do not make loan decisions until all requested information is received. So if the bank asks you for something else, another document, whatever, make sure you get that in a timely manner so that they can make a decision quickly and you understand where you sit. What factors determine if your loan is approved? It really comes down to the 5 C's of credit here. Your character, capital, capacity, conditions, and collateral. And we'll talk about that here in a second, okay? So the 5 C's of credit is the model that banks, use generally in order to decide whether they can give you a loan or not, okay? So they look at first your credit score, which is your character, right? It's probably the single biggest factor, especially on smaller loans. Many small loans are just credit scored, we'll say small, maybe 20 to 50,000, something like that. Credit score, boom, okay. Does it meet the terms? Yes or no? All right. Repayment ability, which is your capacity to pay, okay? Does the business generate enough cash to pay the loan back? Again, is a credit score good? Does this borrower show that they have, paid their loans in the past? Number one. Number two, does the business generate enough cash to pay the loan back? Right? Two key pieces of this. Number three, collateral is the value of all the assets the bank owns. Okay, this is the bank's the business owns. Excuse me. It's the bank's second way out, right? This is the real estate and other things. Right. This is, you'll put this up as collateral, part of the whole personal guaranteeing process, right? And if you're not able to pay the loan and the bank back, then they will take these assets and, sell them or use them to pay the loan off. Okay. That's your collateral. Equity is the amount of money you have personally invested into the business. That's capital on the 5 C's model there. But again, we've talked about that. That's your 20% down. Experience, whether it's industry experience, business ownership experience, or education, right? That's again factored in as part of your character. So, a lot of people want to start restaurants that have no experience ever running a restaurant. Right? Just giving a, kind of one example here that's easy to understand off the top of the head, right? But so you know, you need to show that, you know, if you want to open a restaurant, that you have some experience managing a restaurant. You know, hopefully maybe you've even worked in one before, right? So hopefully maybe you're a chef or something else. So the bank wants to see some experience and the type of business you're in. So what is the industry? Is it a startup business? What are the conditions for this business, right? I always use my typewriter example here, right? If you go to a bank now and tell them you want to start a company making typewriters, right, it's probably not, you know, going to be an investment that they look fondly on. Okay. So, and again, right, restaurants are, you know, seen as riskier. Some industries are just seen as riskier, and it's, you know, and it's not just seen as the numbers have proven it over time, right? It is more difficult to survive in certain industries than it is in others. And the banks have the numbers and risk profiles of all industries to understand which are going to be the most difficult. Okay. All right. So once we go through underwriting and they've looked at the 5 C's of credit and see where you are, one of 3 things can happen. Either your loan is approved, and life is good. You know, the lender will issue you a commitment letter with terms and conditions, and then you'll work on closing the loan. Number 2, your loan is declined, and you know, you will get a notice, and the lender will tell you why you know, the loan was declined, so that you have a better understanding if you'd like to apply for it again, of how you may be able to overcome that. And 3, your loan is approved, but the lender needs to get a guarantee from the SBA. So, you know, that's where the SBA comes in. We have multiple financing programs, and you know, underneath our 7A program are guaranteed loans made through participating lenders. You know, there are 20 different types of loans under our 7A program. You know, they can be lines of credit, they can be international trade, they, you know, community advantage, they can be rural farm loans. There are a bunch of different products underneath there, but basically those are loans made by a bank and guaranteed by the SBA. SBA guarantees, depending on the type and size of loan, between 50, 75, or 85% of the loan for the bank. So if the borrower is not able to pay the loan back, the SBA will pay the bank back 50, 75, or 85% on that loan, okay? Now, that doesn't mean the borrower is off the hook, because you have still had to personally guarantee and put up collateral, right, of your home or whatever else. But we pay the bank quickly, and then SBA would, you know, the U.S. Treasury would come to you looking for the money instead of the bank coming after you. So that's how we've made the process a little bit simpler for the banks, and help them, you know, try to get more loans across the finish line here. Every year, the SBA does $30 billion in loans we guarantee across this country for small business. That's a lot of money that may or may not have get in the hands of businesses without our help. So it's really important, the role we play kind of in the background in financing these deals, or guaranteeing these deals. Our 504 program is an economic development loan tied to job creation. These tend to be for buildings or larger fixed assets and machinery. But basically, this program, especially because these loans tend to be larger because you're building something, in most cases, allows a borrower to only have 10% down, and then the SBA and a certified development company you know, lend the other 90%. So that's a win-win for building, you know. And then our microloan program, our small loans, generally $50,000 or less. The nice thing about microloans is they have a little bit more flexibility on credit score than you might get at a traditional bank. So you may be able to, have a credit score that isn't quite as good and still be able to get a loan based on your business plan and cash flow and that sort of thing. So there are many programs underneath each of these. I'm not going to go, discussing all of them, but SBA is here to help. So our 7A guarantee, pretty much talked about this already, but it's an inducement to a lender to make a loan that they might not otherwise be able to make because the loan request does not meet all of the bank's credit criteria. Okay. Yeah, we talked about that. So why do banks come to us? Something about the loan request that doesn't meet their credit guidelines. There might not be enough collateral. The business might not have enough equity. Could be type of business, could be that it's a startup. They could be a cash flow issue that the business owner wants to extend the maturity, right? Extend the maturity means add years to the loan so that the payment is less. Okay. What do we look for? We look for the same credit issues a bank looks at, but we just look at it in a different order. So, generally a bank will rate the credit score as the number one thing, right? We look at cash flow based on historical performance and or projections. We look at management ability, equity, then credit, then collateral when we look at these. So we're looking at the same things, we're just weighting them in a different way. And that helps business owners be able to access capital that they might not be able to otherwise. Biggest benefits of an SBA guarantee loan. The first one is that the borrower business obtains a loan that they would otherwise not receive. And the second thing is we offer longer maturities than traditional bank loans. So we can go 10 years on working capital, 15 years for fixed assets, and 25 years for real estate. So again, those longer maturities lower that monthly payment for someone and helps to keep more cash in the business on the front end. We don't make bad loans good, we make good loans better, right? We're still looking at all of the same things a bank is looking at. We're just looking at them in different order, to be able to help get the borrower across the finish line. If you need help creating a business plan, so so much of this is predicated on having a good business plan, especially if you're a startup. There are many places you can go. We have resource partners throughout our territory. So I work out of the Buffalo district office, cover the 8 counties of Western New York and the 6 counties that surround Rochester. We have resource partners near you everywhere. I think our Brockport Small Business Development Center has counselors at the Genesee County Economic Development Center, if I'm not mistaken. There used to be somebody there that did appointments and meetings. So, there are SCORE, I believe, the Buffalo Niagara SCORE chapter meets at the library in Batavia. Richmond Library, is it Richmond Library, right? It's been a little while since I've been to Batavia, this whole pandemic. But yeah, at the library in Batavia, they used to do appointments. I know in Orleans County, they also have appointments, the Buffalo Niagara SCORE. And these are free confidential resources. They can help you on any questions or business challenges you may have. Would really recommend, reaching out to have a meeting with someone. Can be done virtually or in person. But, just helpful to kind of bounce some ideas and thoughts off someone, and maybe they can help connect you. So here's a list of, resources that can help you out within our region. We have 3 micro lenders in our district. If you're looking to go out towards Batavia, in Genesee County for one of these, you'd have to use Pursuit or Pathstone. As far as lending goes, Westminster Economic Development Initiative is Buffalo specific, Erie County specific. So pursuit or path zone, and that would be for those, tend to be smaller loans, $50,000 or less, but as an option for you. And that is it for me for this morning. I don't know if anybody has any questions or thoughts or comments, and kind of leave the line open here and see what people have to say. Any questions on financing or anything else? Everything makes sense? Need place to be pointed in the right direction? Tiffany has her, or no, that's not, sorry.
I was just gonna say thank you.
Oh, thank you very much. Appreciate it. So yeah, I'd encourage you to reach out to your local chamber, reach out to Genesee County Economic Development Company. They can link you up with the resources, in town. I'm assuming most of the folks on the call are from Genesee County or, kind of Batavia area. So, and it's free confidential assistance to help you with whatever, questions you have about a business. And, now's the time to, make a meeting with someone and get it moving, so you can keep plugging away and be ready to open up this year or next year, whatever you're thinking about.
If anybody needs Greg's contact information, just email us at the chamber. We can help you out. Like he said, I'm having some internet issues, so if I'm cutting in and out, sorry about that. If anybody has any questions, now's the time. If not, we're gonna wrap this up.
All right, looks like we're all set.
Okay.
Any questions? Good. All right, have a good day, everyone. Thank you.
All right. Thank you.
Thank you. Thanks, Stephen. Have a good one.
Thanks. Thanks, Greg.